Good morning, good afternoon, good evening. Dramatic intro to established tone. Now that it's the weekend, yes, it's Saturday down under in case you don't know how time travel works.
If you travel to the past, that past becomes your future. And your former present becomes the past, which can't now be changed by your new future.
So Back to the Future is a bunch of bullshit?
But now that it's the weekend, if I were a bear, I would be thanking God Almighty it's the weekend. 2 days where we as bulls allow you, bears, the freedom not to lose money. Firstly, you're welcome. Secondly, you're doubly welcome. Thirdly, let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. So guys, if you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a very mixed day across the board. There was some red, there was some green. If we just look at something like the mega caps, we had Nvidia, Apple, Google outperform, as well as Tesla. Then we had Amazon, Microsoft, Eli Lilly, Costco in the red, and that was the same sentiment throughout every single sector. We had data that weighed on the market, we had data that was positive for the market, and that caused quite a lot of volatility in today's trade, and we saw that in the sector heat map. Look at the best performing sector, financials, followed by utilities, then communication services. We have a rate sensitive sector, a defensive sector, and then a cyclical growth sector, up 0.7, 0.5, 0.3% respectively. And then the worst performing sectors was real estate, industrials, a rate sensitive sector, a cyclical sector, and then technology also finishing here in the middle, with healthcare also in the middle. So very interesting. And I think today's trade just all stemmed from a whole bunch of digestion from the data we got this week, but also the numbers that we got today. Housing starts and building permits came in a lot worse than expected. The market was forecasting 1.34 million for housing starts. We got 1.2, and then building permits was supposed to come in at 1.42. The number we actually got right here was 1.33 million, and that weighed on real estate and that weighed on the market. However, consumer sentiment came in slightly better than expected, and that boosted the market, and this led to a mixed day of trade across the factor and size spectrum. Mid caps the clear outperformer, definitely some digestion happening here in the large space size as well as the small cap space, but it was very interesting to see what actually happened in small caps today. If we actually just pull up the chart of the last 5 days of trade and just zoom in here to Friday, we see a very interesting dynamic. This yellow line is the IWM. You could see that the IWM opened right here, and then we had a massive rally up to 3.5%, and then we parred all of those gains, and then we found a bottom and then continued higher, and the IWM was actually up about 0.25% here on the day. But looking at the overall week, we saw a great week for stocks. In fact, the best week of the year for stocks, the best week of the year for the S&P 500 and the Nasdaq since October 2023. Here's a chart with the Nasdaq performance, actually up 5.38% this week. The S&P 500 up 3.93%. The IWM up 3% as well. The Dow Jones not far behind, and the RSP gained 2.5%. And then bonds surprisingly up 1.23%. A very interesting day of trade, and it all started here with the PPI report on Tuesday. We digested a lot of last week's sentiment on Monday, and then the PPI report propelled stocks to new highs, and we just kept making higher highs, higher lows in most indices, the S&P 500, the Nasdaq 100, setting us up to have the best week of this year. But diving more deeper into the minute details, looking at the day-to-day action, the S&P 500 was up 0.02%. The Nasdaq 100 was virtually flat. The Qs posted a little bit more of a gain right there. The IWM up 0.26%, the RSP up 0.25%, mid-caps flat, the S&P 600 and the SPY up 0.25, 0.22%. So very muted day of trade, digesting all of the gains. You have to take the green days as they come, and that's a gain in the portfolios for the people holding mid caps, large caps, small caps, but also for those holding bonds. The AGG as well as the TLT was up 0.24, 0.35%, and that's because yields, 2-year yield, 10-year yield, and 30-year yield actually all fell on the day. The dollar right here was down 0.62%, and gold was up 2.04%, silver up 2.38%, and crude, a bit of a dumpster fire today, down 3%. Super volatile price action in crude, but what's new? But let's dive into the S&P 500 more specifically, and nothing has really changed. 5700 or 5750 is still the core resistance, 5500 is still the gamma flip, and the put support is still at 5300. So we're still still have quite a huge range that we can work with, and nothing has changed. We're in positive gamma, which means we're working our way up to the call resistance and the key levels right here, 55.85 and 56.70, and we want to buy dips here at the gamma flip zone at the 5500 area. I think this is going to move up next week. We probably see 55.50 in the gamma flip. I think we'll also see the put support move up a little bit next week, but we don't try to predict, we just react to the levels. The S&P 500 only gained 0.2%, but that candle is still very constructive. I mean, we opened at the lows, made higher highs, higher lows to the top, and then we had a bit of a wick, but still closing in the top third, and that is a bullish candle, all things considered. And even some of the selling we did get towards the end of the day, you could see here that we actually gapped down on the day and then made higher highs, higher lows, found a top, and then we just had a little bit of risk off into the weekend, a little bit of profit taking after the end of this week. In a week like we've had in the S&P 500, where we've gained 3-4%, a little bit of profit taking here at the top, actually kind of a good thing. It's healthy for markets to do that, and that's actually what we saw. I think all in all, a very solid day after these gap ups we had on PPI and CPI, and I think this just lends itself to higher price action later on in the week. If we actually go ahead and look at the advanced decline line, officially at a new all-time high, that is really bullish, and the RSI not even overbought just yet, which means we have room to run to all-time highs, at least from a market technical standpoint, and things are looking really constructive. If we dive down into the weekly chart, last week this was looking very shaky. We had a very bullish candle. Now that we had follow through, I think we just opened up new all-time highs on the weekly chart. The weekly chart looks really strong right now. This is literally looking like a higher low relative to this in the context of new all-time highs. Guys, this is what bull markets look like. Higher highs, higher lows, new all-time highs. And then we even dive into the monthly chart, and guys, the monthly chart last week was looking really bad. Now positive, the monthly chart looking very constructive. However, the month is not over. We still have about a week and a half, 2 weeks left here in August, but the weekly chart looks really good, and the daily chart and weekly chart both look like they're setting up to go and take new all-time highs before August is done. Now, August tends to be a very bullish month in election years, and what we should really worry about is September. September is when we get a lot of volatility in election years as well as non-election years. So take the gains while they come, because we are still set for a lot of volatility, particularly in the September, October, November time period leading up into the election. But for the year and now, in positive gamma, buy dips, sell rips. Your target is the 5700 area. Let's dive into sentiment. We have some very interesting measures of sentiment right here. This is the S&P Global IMI survey, the investment managers survey, and it's just a survey where they ask, what is your sector outlook for the next 30 days? This side to the right is bullish, to the left is bearish, and fund managers were most bullish on healthcare, utilities, consumer staples, real estate, defensive sectors, and most bearish on discretionary, materials, IT, and industrial, so cyclical. So despite the rally we're seeing in the market, fund managers over the next 30 days still see quite a lot of risks in the market, and the risks they're particularly looking at right now is political risk, valuation risk, the global macro environment. They see all of these as negative contributions, including the US macro environment as well as equity fundamentals. They only see the two positive contributors to returns over the next 30 days being central bank policy and shareholder returns. Now, what's very interesting here is that fund managers are negative on the overall valuation of the market. Let's actually go ahead and look at valuation as well as fundamentals just to see where we stand in the S&P 500. And right now, PE ratios as of August 15th are as follows. The mega cap 8, they include Netflix in the Magnificent 7. They call it the mega cap 8, is trading at 27.6 times. The S&P 500 is trading at 20.1. S&P 400 mid cap trading at 15, and S&P 600 small cap trading at 14.5 PE. This is actually such a bargain when you go look at the growth rates. You're looking at like 19%, 20% growth in the S&P 600 small caps over the next couple of quarters. But by historical standards, the S&P 500 does look expensive. The mega cap 8 does look expensive, but the rest of the market don't look quite overvalued. In fact, they're probably trading at about their historical valuation, if not even cheaper. Now, looking at consensus estimates, 12-month forward PE estimates continue to just march higher unabated. We have not seen this type of move for a very long time. You can see 2024 earnings have remained very robust. 2025 earnings have actually seen upward revisions in the last 8 months since the start of 2024. Very interesting dynamic to see this, and eventually this is going to move up to the 2025 estimate, which is sitting at $280 in earnings per share, which is something like 14% year-over-year growth in the S&P 500. Do I think these estimates are a bit rosy? I think so. I do think they should come down in the back half of 2024, but not a whole lot. I'm thinking if estimates right now are sitting at 14%, I think if we get revisions down to the 13% range, this number right here is probably more likely. However, forward estimates and S&P 500 earnings are growing into 2024, 2025, and 52-week estimates continue to march higher. That is normally bullish. And at the same time, forward margins estimates are tracking at about 13.5%. Current margins are tracking at 12.3%. And I think these forward estimates are very likely to remain where they are. I think we see 13% margins next year, assuming the macro holds up. And then looking at dividends and buybacks, we see the combination of both pretty much at all-time highs. There's only a couple of years at the end of 2022 when dividends and buybacks were higher. Dividends are near all-time highs and buybacks are approaching all-time highs. So stock market fundamentals, I think, look rather good. I think the S&P 500 is probably trading at fair value. And based on these metrics, by no stretch would I be concerned about the valuation of the market. Look, at the end of the day, there's always going to be sectors that are overvalued. There's always going to be sectors that are undervalued. And what we're seeing right now is material undervaluation in mid caps as well as small caps. And we actually see large caps trading at about fair value. Large cap growth, large cap core trading 8.1% over fair value, 3.7% over fair value, and large value actually trading under fair value. Mid-cap growth is trading at about fair value, a little bit over, but in every other segment, core value and growth for smalls and large, materially undervalued. And this is where you're going to get your outsized returns. However, a lot of the companies in this space you need to have exposure to because they're just such high quality companies. They're very hard to get under fair value, and buying them at a fair value and just let them compound over time. That's also how you generate great returns and consistent returns in your portfolios without the high beta of something like small caps. So I don't think the market is overvalued. I think you can find value in certain pockets, and sometimes the overvaluation is warranted just because of how high quality these businesses are. Now let's dive into some macro, and looking at the economic surprise index, we do know that 2024 has been quite the dumpster fire for economic data. However, we have seen a change in path right here in the last 2 weeks, primarily driven by better than expected inflation reports. Both the CPI and PPI, the initial jobless claims over the last couple of weeks, have come in better than the market's expectations, as well as retail sales, which was very strong yesterday. However, it's not all good news because we actually saw the Fed's GDP Now tracking estimate moved down from the 2.9% range to the 2.4% range, and this was in large part driven by industrial production. Goldman Sachs also lowered their tracking estimate to 2.4% on the back of industrial production, and they said industrial production decreased by more than expected in July, and manufacturing production decreased in line with expectations. The Fed estimated that Hurricane Beryl held down industrial production growth by 0.3%. Motor vehicle assemblies decreased to 9.8 million, the lowest level since October 2023. While this morning's retail sales report was stronger than expected, utilities production and auto assemblies were below our previous assumptions. On net, we lowered our third quarter GDP tracking estimate by 0.2% to 2.4% and our third quarter domestic final sales forecast by 0.1% to 2.3%. We left our past quarter GDP tracking estimate for second quarter unchanged at 2.5%. So very interesting data. GDP tracking a little bit lower than expected, however, still robust, and anything in between the 2 to 3% range is very, very strong. Now let's switch gears and actually look at a report we got from Walmart. This is by Walmart CFO John D. Rainey, and he had some very interesting takes on the market, the consumer, and I think it's worth reading. He said, in terms of the outlook for the consumer, let me categorize this or give some context in the second quarter. So each of the months of Q2 were relatively consistent. If you were to look at our pure comps for each month, July was actually slightly higher, but we think this is largely the result of where the days of the week fell in the last week of the month. So we did not see a step down. Our outlook for the back half of the year is really more for a continuation of what we've seen. Even in the first couple of weeks of August here, things have been remarkably consistent. That's very interesting. So I know everyone is looking for some piece of information that maybe indicates further weakness with our members and our customers. We're not seeing it. But we feel like we are, as I mentioned in our prior response, measured in our outlook and positioned to jump in. Very interesting. He doesn't see the consumer weakening. Other markets do, but for every McDonald's, there's a Shake Shack, and Walmart see robust consumerism to continue for the rest of 2024. Looking at earnings next week, we have a couple of notable names. Estee Lauder, I think a lot of people's going to be watching this name. It's been a complete dumpster fire this year. It's down like 50%, I think. Palo Alto on Monday. That's going to be big for the cybersecurity space, especially with CrowdStrike. I think a lot of people are going to be watching how much market share did they possibly take this quarter after the CrowdStrike situation. What's guidance going to look like, and what does the outlook look like for cybersecurity? On Tuesday, we got lows. Wednesday, we have Target, Snowflake, Zoom, Macy's, TJX. A fairly big day, especially in the staple sector as well as the software sector. And then Thursday, we have Baidu, Carva, Workday, Bill.com, Intuit. Very interesting day here. Wednesday, Thursday is going to be a very big day, and then we don't have much of anything on Friday. And then next week with data, compared to this week, we have a fairly tame week of data. We have the US leading economic indicators they released. Then we have quite a number of Fed speakers, Christopher Waller, Michael Barr, the FOMC minutes, and this is all leading up into Jerome Powell speaking at Jackson Hole on Friday. We also get new home sales that day, and then we get the PMIs here on Thursday with existing home sales, and then the stock standard initial jobless claims. Interesting week of data, not quite as big as this past week, but we can definitely see volatility, especially with Jackson Hole, Fed speakers, the PMIs, and these leading economic indicators. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.